Welcome everyone to the first outlook of 2025. Eagerly anticipated. I know you've all probably missed me and I've missed you as well. Hopefully you had a good new year with your family and loved ones, and you also managed to take some time off the charts to reset and rejuvenate your brain. For 2025, it's going to be a good year, a lot of printing to be done, but we need to do it in the right ways. So this week, I may do another live. I did a little short one with a few of you today, just to get back in the swing of things, get everyone's brain ticking again, and to get myself back into the mode of actually looking at the charts and trading. So this outlook again is I'm just going to cover bonds, DXY and NQ. Going to keep it nice and short. I don't want too many assets to be brought into it, and I do have, as you can see here, a new little set of asset classes that I'm going to be that I have been monitoring, and I'm going to monitor alongside you. So I look forward to going through some of those in the future, but for now all we're going to do is look at bonds, DXY and NQ. So with bonds right now, as you can see on the 30-year, we've ran this high here, which is Monday the 22nd of April's high in 2024. On the 10-year, we haven't ran that high yet. So some of you may be thinking, well, Wolfpack, why do you think that is a key high? Well, firstly, you can see here, we've got a swing, a short-term high there and a short-term high over here, so we've got intermediate-term highs. So I'm always targeting the intermediate-term highs. Why? Because I've got a high chance of reversal, larger liquidity pools, and price will oftentimes give you a better exit at a intermediate-term high than a short-term high. Basically, it's got a higher probability of being traded to when you're in that buy program, and it's going to be a better exit, better target, and a more solid foundation for you to make predictions from. So that's why I'm looking at that high specifically. And some of you may be thinking, well, that's an SMT. Well, it's another key thing that I want to go into quickly about SMT on bonds, but not specifically to bonds, SMT in general. But with SMT here, you can't just say that it's formed when prices, as you can see along here, bullish, ran this high. 10-year hasn't run the high, but the key thing about SMT is you need to see a swing point formed. So for SMT to be formed, you will need to see a candle close and then a swing point to be formed like that. Combine that with a change in the state of delivery, which would be this candle here, then you have the solid foundation to say that this is an SMT. You can't just say as this trades through the high and this is approaching it, the high, that this is a turning point. Some of you may have taken a trade based on that in the past because there's been almost no indication that price is no longer bullish yet. You need to see that there's a swing formed, so in this instance it will be a swing high formed that doesn't take out the SMT high, and then it gives a change in the state of delivery. If it's a swing high that just does this, so the swing high is like that, so we've got the 3 candle formation, and then next candle you see it run through those equal highs, that really clean equal, maybe that not that exaggerated, but you see it run through those clean equal highs. Well, you said, oh, that's a swing high form there, so that must be an SMT. But notice here, this candle doesn't close below the opening price of the what would have been a bearish order block. So don't get tripped up with SMT when you just see, oh, that high's been ran, now it's an SMT. Not necessarily. Sometimes it will play out and it does become an SMT, but if you want real confirmation and real understanding that, okay, this is a smart money trap or a smart money technique, whatever you want to call it, that this is showing the indication of a cracking correlation, bit of a tongue twister there, then wait for that a swing point to be formed, whether it's bullish or bearish, and then the change in the state of delivery. So it would look something like this, where you have that swing point formed there, change in the state of delivery here, and then you have the idea that, right, okay, this could be treated as a SMT where this high has been left intact. So we have bullish bonds trading through the highs, And on the 5-year, just want you to know this FEG as well, same high, same date, same everything, but this could be a potential area if we maintain bullishness for reaccumulation into the high, or potentially if this wick here wants to be used, that this becomes that what I mentioned before, where we have swing point, maybe just a run above this high here, and then that change in the state delivery would come along here. So that could be a potential scenario for the 5-year, as it is the weakest in relation to the 22nd of April's high. So that's something to take note on the 5-year note. So moving on now, so we've got bullish dollar as the bonds drive the dollar, so we're currently looking bullish on the dollar, and I've just got that range high there noted and this range low. So this is a really long-term target in probably a couple of years, and then also the 114 level. So on the weekly on the dollar, we've got a current breakaway gap here, and then we've just had an immediate rebalance above that range high. So with the bonds being bullish, I'm going to maintain that bullish idea, and I want to see if price wants to reach up into this inversion fair value gap. If price does reach into the inversion fair value gap and reject like this, these are the targets here. So that said FEG there, so that old breakaway gap will be a target, and then ultimately so will this type 2 intermediate term low. If it doesn't, on the other hand, and we see price explode higher and through this, that would give me the indication that, okay, through the first 2 quarters of the year, this is the real target for the dollar, and that Trump administration with the strong economic policies that they're coming out with, because although it doesn't directly drive price, they definitely influence price. So if the dollar is having reduced taxes, which Trump is looking to put into office, that will create a more liquid dollar. What would that do? Increase circulation of the dollar, more trade being done in the dollar. Barrels of oil are already being traded in dollar, but if you start to see taxes coming down, people have more cash to invest in places, and that will create a more liquid asset. So the dollar index would be likely a more bullish market than some other currencies and assets that stay with the same kind of taxation and regulation. So with the fact that Trump's come into power, we have one or two things. Line in the sand here, inversion FEG. If it does get traded above, reclaimed FEG, and 114 is the target. If we see a reaction from here lower with changes to the state of delivery, and we start to see that confirmed with SMT on the bond markets, then this breakaway gap and low will be the target. So that is the bonds and dollar. And remember the points that I said about SMT. And now on NQ, I have a pretty mixed bag on NQ. Today, before I went into the stream, I was bullish on the day with the idea that, if I show you on the hourly, so we have SMT here with this low on ES. I had the idea that we were going to form a market maker buy model, with this being the sell side of the curve here. Let's make that red, and then this being the buy side of the curve here. So that was what I came into the session with the idea of. So with that in mind, just draw that a bit better actually. So this where I saw price going all the way up here and through this external high throughout the next couple of weeks. But in actual fact, what we're starting to do is dive lower. So what that means is I was anticipating this to be original consolidation, where we would trade up into the new day opening gap after we ran these short-term lows. So today in the live, I was saying to the lads, when we trade up into this FEG here in session and we run out this high over here, we're trading into what? A breakaway gap drawn liquidity, an intermediate term high, and then, so if I go on to the 30-minute, and show this in a bit more detail. So on the 15-minute here, we've got FEGs along here, and then what do we have? We've got intermediate term high, like this. And when were those highs formed? Around the session end. So they're the session close on a Monday highs. So when we ran that, I was saying, right, look at this equal low sell side liquidity down here as a target. Now, why would that become a target when I'm expecting a buy model? Well, when we have the first stage of distribution, so this portion of the distribution here, and we put in short-term lows like this, usually for the second stage of distribution, you'll see some time distortion like this, drop below here, pairing of orders, so they're buying these sell stops, and then that will propel us into the first target, which is here. First target, which is this external high on the buy side of the curve, then the new day opening gap, then the external high original consolidation. So those were the indications that I was giving to the fellas who came into the live. What has actually happened though is we've displaced through that low, disrespected, on the hourly, so what we have actually done is not wicked into this area where I was anticipating we would pair orders and send it higher. So anywhere within this area in here, I was anticipating something like this, where we had that big initial wick and then a reaction to the upside. With it being so quick here, I was telling the lads, right, I'd expect high resistance up until here, and then tomorrow I'd look for a position once we'd got some sort of lower time frame FEG or a breakaway gap, and then immediate rebalance, anything of the sort to trigger us into a trade. But in actual fact, what we're seeing now is displacement through these levels. So that's a key indication that this right here is more than likely the original consolidation of this short-term fractal of the market maker buy model. So the low of that FEG is looking like the terminus for this fractal of the market maker model. So I'll be no longer looking for buys if we close as we are today, which is extremely bearish. So what in actual fact it is we have this original consolidation, sell side of the curve, buy side of the curve here, which is okay. That's a nice fractal of a market maker model, which I was anticipating this was the whole market maker model. You're not going to be able to predict every reversal point, but if we maintain probability throughout our trading, that's when you get the consistency. Apologies. So now what I'm seeing is, right, okay, we had this old area where price traded up higher into it, and then a drop off. So we've treated it as resistance, and then here inversed it. So now we have from here to here inversion FEG. Now we're getting that displacement through it. So what I'm seeing is that price doesn't want to reaccumulate orders at a logical area where we've got counterparty liquidity, nested PD arrays, so this rejection block that didn't get retraded to here or here before the drop. So it's almost completely untouched. That's perfect when it's being traded on the other side of the curve. Where does it first trade into it? Here on the buy side of the curve, trades through it here, and now I was looking for that and this new week opening gap to be the catalyst for higher prices. Doesn't look like that's going to happen, but now instead what we have is lower targets. So lower targets here is this stupidly clean level through here. Stupidly clean. There's multiple lows along that sell side liquidity level there, and also we do have a breakaway gap drawn liquidity that did get met in the AM session. So we've got two really clean levels, which is this level here and this level here. But in between that, I just want you to have a look at this area in here. So a lot of you will often maybe get confused with what this is, or what its meaning is, or what significance it holds, and because it just looks messy and undesirable to look at with an idea of, oh, what is actually going to happen here. So right here we have a balanced price range, and that basically means we had buy side, sell side, buy side again delivered. Along that leg of price is efficient in the way it's delivered. It's offered buy side, sell side, and buy side again. So what that means is you could expect from here to here, this is going to be a high resistance zone. So in the same light that from here to here, this is almost like a dead zone. This is all balanced in its delivery. So what does that mean? Well, what that means is prices, as you can see here, it's wicking into that balanced price range and it's having high resistance. So this is where we can anticipate some short-term time distortion, where through the PM session and the Asia session before tomorrow, we can anticipate high resistance price where it might look a bit ugly, run a high, come into a PD array that we were looking at, which is the PD arrays I've mentioned along here, and then that's the drop. So when you see an area like this where it's efficient in delivery, just know that price is going to struggle to break through it, and you can expect high resistance. Even if it's breaking lower like this, it's going to be high resistance. Why? Because price seeks two things: liquidity and inefficiency. If there's no inefficiency in this whole area or real liquidity for it to come and sweep, it's going to struggle to liquidly break through it. Compare that, so we've got this very balanced area in price, and if I just clean this up, compare that to here. So here we've got little FEGs along here. You can see all these FEGs along price. So there's constant displacement, although it's not to a great magnitude. And look at the difference of price and how it acts through these areas of inefficiency and liquidity, because that's what price wants to seek: those inefficient areas and those liquidity pools. Therefore, it's going to take a lot overnight for us to, through the PM and overnight, for us to just breeze through that. So that is almost like the sticking point. We've already met one target, there's another target resting below it. So that is why balanced price ranges are worth identifying and understanding the significance of them. And a lot of you may already understand that, some of you may have never heard of it before. So if you don't quite understand it off the first go, or quite understand why price struggles at those areas, don't be afraid to just ask me. I'll go over it again through other examples and on the lives until you do understand it, because it's very key to understand that, right, okay, there's not really a high probability PD array in here that you could say, right, okay, price is going to trade away from, but because we're bearish. But at the same time, what is price likely to act like in that area is something to find value in. So pretty much what that means is you could expect time distortion. So the rest of the PM session and Asia should, obviously not this tight, but should move around like with a unwillingness to reach through it. So hopefully you found that insightful, and I will catch you inside the group. If you have any questions, just feel free to message me, and let's kick off 2025 in the right manner, doing the right things, and hopefully we can start to print some cash in the coming weeks.